Hi folks, welcome to another episode of Who Said What. I'm Kashish filling in for Krishna. If you're new here, here's the quick context. We pick the most interesting, sometimes spicy comments from business leaders and fund managers and break down what's really going on behind them. We've been tweaking the format a bit, and this is the new version that I've been trying right now. Our previous episode was the first time we experimented with this, and people seem to have liked it. So we'll continue for a little while. This builds on a newsletter we run called The Chatter, where we track what managements are saying in their earning calls or TV interviews. But instead of looking at those comments in isolation, this format zooms out. We track one theme across companies and over time to see how the story evolves. The goal is to connect the dots and understand deeper shifts shaping an industry. For today's episode, I wanted to understand what's up with e-waste in India and how have the rules surrounding it evolved. Here is what we found. Every year, India throws away the equivalent of a small mountain of electronics. In FY 24-25, the Central Pollution Control Board counted roughly 14 lakh tons of e-waste. That's discarded phones, televisions, refrigerators, cables, batteries and whatnot generated across the country. That's up from 7 lakh tons in 2017-18, almost double in 7 years. By total volume, India is now the third largest e-waste generator in the world, behind only China and United States. The rules to handle this have technically existed since 2012, but having rules and enforcing them have been, for most of the time, entirely different propositions. The story of India's e-waste framework is the story of a government that kept tightening its grip until the industry reluctantly started moving. What follows is that story, told through the people building and paying for the new system. The first iteration of India's e-waste rules arrived in 2012 and operated under an optimistic principle that producers of electronics would voluntarily take the responsibility for what happened to their products at the end of a life. It did not work. Extended producer responsibility is the idea that the company which profits from selling a product should bear the responsibility for what happens to it when the consumer is done. As a principle, it's intuitive. As a regulatory mechanism, it requires enforcement. The 2012 rules provided the principle without the enforcement. 4 years later, the government upgraded from voluntary to mandatory. The 2016 rules set escalating collection targets, 10% of historical sales in the first year, stepping up to 70% by 22-23. But the rules had a structural gap: verification. Producers self-reported their compliance. Penalties were modest, and the informal sector, which included hundreds and thousands of waste pickers, kabadiwalas, and crew dismantling units operating across Indian cities, continued to handle the overwhelming majority of the e-waste, exactly as it always had. The breakthrough came not from environmental enforcement, but from trade logistics. India's electronic industry runs on imported components. A company that couldn't clear customs couldn't really sell. Tying the EPR compliance to enforcement clearance was the enforcement lever that actually worked, because the cost of non-compliance was no longer a penalty. It was actually their supply chain shutting down. The rules continued tightening. In 2019, the scope of products covered under this EPR expanded from 21 categories to 30 categories. The e-waste management rules of 2022 expanded that further to 100 product categories, adding tablets, GPS devices, modems, air purifiers, medical equipment, solar PV panels and modules, and even laboratory instruments, amongst others. The trajectory here is worth pausing on. From 21 to 30 to 100 plus products, from voluntary to mandatory to customs enforced, from self-reporting to digital certificate trading market with a government set price floor. Now, each step was tightening of the system. Before getting into how industry has responded, it's worth explaining the mechanics, because EPR certificates are doing a lot of work in the story, and the concept is less intuitive than it sounds. So hear me out. An EPR certificate is a proof that certain quantity of e-waste has been collected and scientifically processed by an authorized recycler. Under the e-waste management rules of 2022, every producer, any company that manufactures or imports electronics, must meet annual recycling targets based on what it sold in prior years. The current target is 60% of historical sales volume, stepping up to 70% by FY 25-26 and 80% by 27-28. A producer can meet its target one in two ways. Either they run its own collection and recycling program, or buy EPR certificates from authorized recyclers who have already done the processing. This certificate trading mechanism transforms a compliance obligation into a tradable market. CPCB launched its EPR electronic trading and settlement platform to host it. Certificates here are denominated in kilograms of waste, and they're priced by category, and they're valid for 2 years. As of 2024-25, EPR certificate prices for e-waste has ranged from roughly 10 rupees to 50 rupees per kilogram, with a minimum floor price of 22 rupees per kilogram established by the government amendment in March 2024. Now, this floor price is the live controversy in the system. The logic here is, without the price floor, certificates could have collapsed towards zero, making it economically irrational for formal recyclers to invest in infrastructure. The counter-argument, which is advanced by several of the country's largest electronic brands, is that the floor distorts the market and constitutes an unfair financial burden. In April 2025, a group of major OEMs like Decode, Samsung, LG, Havells, and Voltas, amongst many others, challenged the floor pricing mechanism in the Delhi High Court. The case is ongoing. It captures a central tension in the system. Government is trying to make formal recycling economically viable. The brands whose products create the waste are pushing back on what costs them. For appliance and consumer electronic brands, the shift from theoretical compliance to actual accounting showed up in the earning call of FY 23-24, roughly when CPCB moved from accepting broad industry data to issuing specific company-level targets. This is the moment the rules became real for companies. Until CPCB issued company-specific numbers, the obligation existed, but the liability was really undefined. Once it was defined, it had to be provisioned for, and the quantum is not small, nor is it stable. Bajaj Electricals, whose lighting and appliance business generates significant amount of e-waste obligation under the consumer electronic and electrical equipment category, gave a clean accounting of where it stands. The cost is essentially doubling, and that isn't an anomaly. It's arithmetic. You see, EPR targets step up every 2 years. The compliance cost scales accordingly. For Havells, a company with broader product categories and a larger sales base, EPR has graduated into a named line item alongside commodity inflation and energy efficiency regulation changes. The BEE changes reference is to the Bureau of Energy Efficiency star rating upgrades for appliances, which impose their own compliance cost. So companies are now managing a convergence of regulatory cost pressures, and e-waste is clearly one of them. The costs will eventually move into product prices. The question is now about timing. The producer side response of absorbing costs, buying EPR certificates and timing the price increases is one approach to the new compliance reality. Amara Raja Energy and Mobility chose a different one. Battery companies operate under a parallel framework to the e-waste rules, the Battery Waste Management Rules of 2022. The structure actually mirrors the e-waste system. It has EPR registration, collection targets, certificate trading. But the targets here are actually much steeper. For automotive and EV batteries, the requirement is 90% collection and recycling by FY 26-27, with minimum recycled content mandates in the new batteries from FY 27-28 onwards. Now, Amara Raja is one of the India's two largest lead-acid battery manufacturers. For a company whose entire business runs on lead, buying it, forming it into batteries, selling those batteries, and now bearing the regulatory responsibility for what happens when they die, in-house recycling isn't really a compliance option. It is also a raw material strategy. Lead-acid battery recycling runs in two stages. First is battery breaking. Here, the spent batteries are shredded to separate lead plates, plastic casings, and acid. And then there is lead refining, which smelts the recovered material into usable metal. Amara Raja's facility, called ARCSPL, was being built in phases. Refining came first, battery breaking would follow. This sequencing matters because a refinery without its own breaking operation still buys pre-processed lead from the market. Only once both stages are integrated does the company fully control the loop. The investment rationale here is also direct. Phase 1 is approximately 500 crore rupees, and the board approved an additional 200 crores for Phase 2. At full scale, the plant would supply 30% of Amara Raja's lead from recycled material, basically insulating them from the portion of its raw material from price volatility and from margins lost when sending the scrap to outside smelters. By Q3 FY25, the refining phase had commenced commercial operations. And then came the harder math. A 10 to 15% shortfall in collection means buying EPR certificates. And buying EPR certificates means provisioning for a cost that is uncertain today and likely to rise. The clause, provided the scrap recycling price is competitive with LME rates, contains the whole economics of formal battery recycling in one sentence, and it's worth unpacking it slowly because it explains why the regulations alone can't fix the supply problem. You see, the LME, which is London Metal Exchange, is the global price benchmark for industrial metals. Lead trades on the LME the same way oil trades on Brent. It sets the reference price that every buyer and seller in the world uses to negotiate. Now, when Amara Raja buys lead as a raw material, it pays something close to LME spot. So when it processes scrap through its operations, the value of that lead it recovers is also measured against LME. So the economics of recycling here are simple. If your cost to process the scrap into usable lead is actually lower than the outside LME price, recycling makes sense. But if it's higher, you're better off just buying new lead at market prices. The problem is what it does to scrap collection. You see a formal recycler who is paying GST, running compliant asset disposal, employing workers with safety equipment, maintaining all these regulatory certification, it carries a very significant overhead. That overhead limits how much it can afford to pay for used batteries at collection point and still turn a profit after processing. The informal sector carries almost none of these costs. There's no GST, no compliance, often no safety equipment at all as well. Their lighter cost structure means that they can offer battery sellers, which are auto repair shops, retailers, or even consumers, a higher price for the scrap than formal recyclers, and they can still make money. This is an outbidding problem. Batteries flows to whoever pays more. In most parts of India, that is still the informal operator. Amaraja's collection program falls short because the scrap it needs is being outbid at the source itself by the informal guys. The gap then has to be closed with EPR certificate purchases, which is a financial cost and not really a recycling solution. Amaraja's own recycling plant partially changes the equation. When you process your own scrap, you capture the full value of recovery without paying a middleman. You also have more control over what you pay to collect because you're not relying on an external recycler's pricing. So now the question is whether the plant's recovery ratios are good enough to make in-house processing cheaper than buying lead at LME prices. That's the real test still ahead. That said, by Q3 FY26, the recycling plant was contributing to margins. Modestly, but measurably. The battery breaking phase, which is the next phase, was expected in Q4 FY26. The last sentence is an important acknowledgement. Recycling is structurally a lower margin business than manufacturing. The economics work through volume, through recovery ratios, how much usable metal we can extract from each kilogram of scrap, and through the avoided cost of buying new material at market prices. This is a margin improvement story, not really a margin transformation story. Now, for all the progress on the formal side, certificate trading, customs enforcement, company-level EPR targets, the informal sector remains the dominant physical reality. Moving from 1% to 25% formal in 4 years is real progress. It is also a reminder how far the system has to go. Studies have found that 76% of workers in informal e-waste units suffer from respiratory ailments. An estimated 4 to 5 lakh children between the age of 10 to 15 are engaged in e-waste handling across the country. They work with lead, mercury, cadmium, arsenic, typically with no protective equipment, in conditions that actually cause permanent health consequences. The informal sector persists not because of the ignorance of rules, but because of a structural economic advantage. Informal operators pay cash, carry no GST overhead, have no compliance costs, and can outbid the formal recyclers for scrap at the street level. The 18% GST on e-waste and metal byproducts falls only on registered businesses, giving the informal sector an embedded cost advantage. The minimum EPR floor price of 22 rupees per kg was partly designed to help these formal recyclers compete. Informal operators aren't bound by it. The ask from the formal recycling industry isn't a change in tax rates. It's a structural fix to make the market more traceable. So a quick note on what reverse charge mechanism would actually do here, because it sounds technical, but the logic is pretty simple. Start with how GST normally works. When a kabadi wala sells scrap batteries to a recycler, the kabadi wala is supposed to collect 18% GST from the buyer and remit it to the government. But the kabadi wala is almost certainly not GST registered. He's a street level collector working in cash. There are hundreds and thousands of him across India. Enforcing GST registration at that level is practically impossible. So in practice, the transaction happens with no tax collected, no receipt issued, and no record of it anywhere. The e-waste just moves and disappears into the informal system. Reverse charge mechanism flips who is responsible. Under RCM, the buyer, in this case the registered formal recycler, pays the GST directly to the government instead of the government collecting it from the seller. The kabadi wala doesn't need to be GST registered. The formal recycler who's already in the system simply includes the purchases in their GST returns and pays tax on it. Here's what changes. Every time a Tero or Amara Raja buys scrap from any source, registered or not, the purchase becomes a line in their GST filing. CPCB can see that at any point exactly how much material is flowing through the formal recycling system, where it's coming from, and at what volumes. Today, none of that is visible. The informal supply chain leaves no paper trail. Crucially, the total amount of tax paid doesn't change because RCM is not a rate hike. The economic cost of transaction stays the same. What changes is that it becomes legible. This matters enormously for EPR compliance because right now the government cannot reliably verify whether the recycling claimed on the EPR certificates is actually happening. RCM would attach a paper trail to every purchase at the point where informal supply chain meets the formal one, which is the only point where it's practical to enforce. India's e-waste rules were designed primarily as an environmental compliance framework. They're increasingly now becoming something else, a resource security mechanism. India has 100% import dependency on several critical minerals like lithium, cobalt, nickel. All of these underpin the EV and electronic supply chain it is simultaneously trying to build. China dominates global rare earth supply. As of 2025, has imposed export restrictions on several of them. Every ton of e-waste processed formally is a ton that partially offsets that dependency. A printed circuit board contains roughly 0.2% gold, 0.5% silver, and trace amounts of palladium and platinum. The value embedded in India's 1.4 crore tons of annual e-waste is estimated at approximately $6 billion. The formal sector's response has been to build digital supply chains capable of competing with informal networks on transparency and traceability, if not always on price. Atero claims over 30% market share in EPR certificate market, more than 3 times its nearest competitor. That concentration reflects how new and fragile the formal sector still is. A market where one player holds 30% of volumes is not really a mature market. It is one in early formation, which is exactly what makes the next few years very consequential. India's e-waste rules have come a long way since 2012. The formal sector's share of physical e-waste processing has moved from 1% to 25% in 4 years. Companies that once treated EPR as a footnote now provision for it as a growing line item. But the numbers also show how much distance still remains. 3/4 of India's e-waste still flows through informal system that the rules alone cannot reach. And this is not because enforcement has failed, but because informality has a structural economic advantage that compliance mandates haven't closed. The formal sector needs more than rules. It needs GST architecture, financing, and infrastructure to compete on price. The rules that found their teeth over the last decade will need to grow a new set. And that's it for this edition. I hope you watched it till the end, and if you did, do let us know in the comments whether you liked it or not. We're still experimenting and figuring what works and what doesn't. Hopefully, I'll see you in the next one.